Hey, it's Mark Podolsky, the Land Geek, with your favorite niche real estate website, www.thelandgeek.com. And today's guests we're bringing back. But before we get into it, I'd be remiss if I didn't properly introduce my co-host, Six Sigma, the leader of the greatest group training on earth, Flight School, Scott Todd from scotttodd.net, landmodo.com. And most importantly, if not automating your Craigslist and your Facebook postings, postingdomination.com/the Land Geek. Scott Todd, are you excited to get into this?
I'm excited, man. I can't wait. Let's go.
I can't wait either because I was, we had Chris Miles on a previous podcast, and then I was on Chris's podcast, and we started talking about this concept that I'm kind of like vaguely familiar with. And we're going to get into it. But if you don't know who Chris is, Chris Miles at moneyripples.com is your financial advisor and money mentor. He is the cash flow expert, and he's a leading authority on how to quickly create cash flow and lasting wealth for thousands of his clients, entrepreneurs, and others internationally. He's been featured in U.S. News, CNN Money, Bankrate.com, and luckily for him, he's finally on a prestigious media outlet, The Art of Passive Income. Chris Miles, welcome back. How are you?
Great. It's good to be back on.
So let's just get into it. We're talking about this concept of infinite banking. And you said, oh, yeah, I've got something even better. And it was kind of similar. It was kind of different. And then I'm like, well, what about the QRP? And you're like, yeah. And, but this is something like that. So I really want to get into, on a deeper level, what is infinite banking? What is it that you're advising your clients to do, and how that differs from a QRP? What are the benefits and what are the disadvantages? Let's get into it.
All
I
right.
know there's a lot of questions at once. How do you like the shotgun approach of questions?
I love it. We'll just address one after another, right?
Okay.
So, yeah, really, like when you talk about here, the infinite banking concept, you Google it, you'll find all kinds of stuff on it. Really, it's life insurance agents that are using stuff, right? Here's what it really is. Like, here's how I see it and how I use it from my perspective, because I'm a business owner first and foremost, as well as an investor, right? Yes, I've been life insurance licensed for the last 16 years, but I kind of look at things from a very different angle, and I like things to be simple and easy, and I'll tell you, like, if you look up that stuff, you'll have so many varying opinions and so much crap out there. But here's the thing, is like, I use this as a supercharged savings account. Like, I want my savings on the steroids, so to speak, right? For example, like, you'll see most people, like, when they go to invest, they take money out of their savings and they go and invest it. And so you take money, you go make the rate of return. So you go put into land or whatever you might be investing in, whether it's cash flowing or not, you go and you hope to make a great return. Now, obviously, I'm anti 401k and IRA type stuff, like, I'm anti qualified plans because I don't like the government having control and changing the rules whenever they feel like, and so with this, it's like, okay, cool. I can take money out of savings and go invest it. But there's a lost opportunity cost there, because now I'm taking money out of savings and putting it into a place to make money. Now, what if I can make money two places at the same time? Obviously, that would be a no-brainer, right? It's like, if I can make money in savings and make money in the investment and have that money, like, kind of make little money babies, and do the same thing all at the same time, wouldn't that be awesome? And so that's where infinite banking comes in. And that's where, like, when I talk about using this strategy, this is a strategy that not only that allows you to do that. One, in a savings account, the one problem is you're earning 0.0%, right? That's one problem. You earn nothing in a savings account. Plus, you get taxed on that 0.0%. And so whatever little you make, you get taxed on anyway. So it's really like, it's crap. You might as well just bury it in your backyard. That's really what it comes down to. Here, we try to make it to where you can make whole returns, like an average of like easily 4 to 5+% after, like, that's tax-free returns. Now, most people, they can even get that in their 401k. That would be pretty awesome. When you factor in that they have to pay taxes and fees and everything else, 4 or 5% is actually kind of what you would hope to make in a 401k, with normal mutual funds and crap like that. But what if you can make those returns and still make the same returns in your investment at the same time? That's where this comes in. And so the vehicle we use to do that is using whole life. Now, how does that work? How do you actually do that? Well, let me explain like what I did with a savings account when I did some investment about 11 years ago, I guess it was, back in 2006. I remember I had a $25,000 savings account, and I remember realizing like, wait, I can leverage, money. Like when I started to realize that debt was fun, it could be actually okay if you use it right. I thought, well, hey, I got $25,000 in a savings account. Could I get a loan off that? And so I went to my bank, went to the credit union that said, hey, yeah, I'm making 1.5% in this savings account because that was awesome. Back then that was normal, not today, right? I was making 1.5%. I said, hey, could I get a line of credit or something against this? And guess what the bank said? Well, of course, right? Why not? And so we did. So we got a line of credit against it. They said, great, we'll charge you 4%. You'll earn 1.5%. So I was still earning the 1.5% on my $25,000, but I was also paying the bank 4%. Now here's the kicker. This is the thing that blows people away and blew me away even just a matter of years ago, is that simple interest that you get charged on a debt or on a loan is not the same as the compound interest you're earning on your savings. For example, you get a 5-year car loan and say you get it at 3%. Did you know that if you had that money, say that was a $30,000 car loan you could have got, right? But instead you had the money in cash, and you could have paid it all in cash, but you didn't. You decided to leverage the bank anyways. Now, the thing is, when you have a 3% car loan, everybody will tell you what interest you have to beat with your returns to be able to pay for that car. What do you think people will say?
3%.
3%.
Yeah, exactly.
Or over 3%, right?
Or over 3%, right?
Right.
Guess what? If you do the numbers, say you take that $30,000 in savings, run the interest example. Like if you paid a car payment over 5 years, right, at 3%, you'll see the interest is only so much. You do the compound interest on it, you do it at 3%, you make well over double the interest, even at 3%. The break.
Now, is there a simple interest calculator I can look up online and a compound interest calculator?
If you just go to calculator.net, that's an easy place to use. I just use that, show people that. But yeah, just do that 30,000 car loan, 3%, and figure out, you'll see the monthly payment, but look at the total interest. It'll surprise you that it's actually not that much. You're like, oh, it's like a couple grand. That's it? Like, are you sure? Because 3% over 5 years should be like 15, right? No. It's seriously much less than that. And so you're probably looking more like a couple grand, actually, to be exact. Probably no more than like $4,000, I would guess. I haven't run the numbers, obviously. I'm just doing this off the top of my head. But that's the key. Now, if you want to see what it takes that $30,000 in savings to at least match the interest, put in 1.5% in that same kind of interest calculator, right? Like a compound interest calculator over 5 years. $30,000 growing at 1.5% will equal about the same amount of interest as 3% on a 5-year car loan.
Well, let me just interject here because Scott Todd is a numbers guy. So Scott, what is your
brain working right now?
Yeah, I can see the wheel spinning.
No, it's the same. No, I agree because Mark, remember when you're paying down a debt, you're paying the interest on the principal today, and every month the principal goes down. So exactly. I mean, you're not really paying 3%, even though you think you are, because you're paying 3% on the balance. Versus, if you were to really get like an effective rate, it would be less than that.
Exactly.
So basically, even on a depreciating asset, we should be using debt, correct?
Yeah.
Not the cash, right?
Right. As long as you can outpace it.
So like my grandfather's like, if you don't have the cash, you can't afford it.
Uh-huh.
Right? Yeah. You're saying, well, not necessarily.
Yeah. It's like, I remember there's this network marketing company that was, I was listening to this financial advice that these guys were giving, and they were giving it from the stage in front of thousands of people. And I remember the guy saying, yeah, you get a $150,000 loan. You know what you pay over those 30 years? $450,000. Now, understand, I used to do mortgages. I did all the truth in lending statements and stuff and would show that to people at closing. I'm like, that's what does he come up with those numbers? I ran the numbers. I'm like, what kind of interest would you have to do to actually pay double the interest of what your principal was, right? And you know what it was? It was like 9.35% mortgage. I was like, this guy's on crack. I was like, the truth is, you get $150,000 mortgage over 30 years, you might be paying about $120,000 with today's rates, right? That's kind of what it's more like. So yeah, you're paying that interest. But here's the thing, $150,000 mortgage, even if you could pay it today in cash and save yourself that $120,000 over 30 years, do you think that in 30 years you could take $150,000 and make more than 120?
Well, not if it's sitting in my bank account. Like I went to BBVA yesterday, and I saw like a big fancy ad, 12-month CD, 1.47%. I'm like, 1.47%, better than what's in my savings account right now at 0.001% or whatever it is.
Right.
So this could not be coming at a better time. So from a practical standpoint, then you're saying you buy whole life insurance as a supercharged savings account, but you have an insurance component. So if you die, you get the insurance, correct? Tax-free. Oh, Chris, you kind of, he's frozen on us, Scott. Do you see that?
I hate when that happens.
The
right
internet.
at the best part, man. Like I remember we had a podcast where we got to a part like this before. Remember that, Mark?
I do remember that.
And
So are you?
I think
are
it was
you,
like the same.
Are you skeptical, by the way? Whenever I hear life insurance,
No,
I get really skeptical.
No,
I don't know
I'm
why.
I'm not skeptical. I mean, like, life insurance, a whole life insurance policy does in fact have that cash component, right? But I think that the problem is that I've got to take, $100,000 or whatever the number is. And Chris, I'm just speculating here, right? Like, because I don't have all the answers, but I think that you got to take let's say $100,000. You take $100,000 and you put it into a life insurance policy, and then you're taking a loan on the life insurance policy. So the life insurance policy is continuing to grow, and then you've got this loan, and so essentially, you're borrowing off of the life insurance component, the cash component. And that's not necessarily to me, it's not necessarily a big deal. I think that the challenge is that you actually have to put in $100,000, right? Like, I don't think it works with like 50,000. I don't know. I don't have the exact numbers, but essentially you're taking a lot of cash and you're kind of locking it up in there. And yeah, you can go back and get it as a cash component, but I don't know. I don't know. I don't know, Mark.
Well, hopefully he's going to come back, because I want to know the differences between this and the QRP. The QRP allows us to literally have total control of our money.
Check this out.
In the Roth component, it's tax-free.
I know in the QRP too, we can buy life insurance, which you can't buy in a 401k. We can buy life insurance.
So we can combine both?
I think we could.
So if we could do that, because like right now, I've got cash. You've got cash sitting in the savings account, right? Because we're running these entities, and so. But is there going to be some kind of penalty to have it flow in, flow out, flow in, flow out?
I don't think so. I think it's
so. This might be a great 1-2 combo. Maybe it's not either or. Maybe it's both, but I still don't know because Chris has not come back.
And I'm telling you, I know for a fact it was with MC. Remember MC?
MC Laubscher.
Yeah,
right.
And
the best
it was
part.
Right at this part, exact same part, and it was a similar topic too. Remember that? It was a similar topic.
Yeah, it was. It was
gone. Yeah. So maybe this is just what happens. It's like when you start talking about it, you're like cut off.
Yeah. It's interesting because when we do the boot camp surveys and we ask people about, what'd you like best? What would you change? A lot of people, I would say a lot. I'd say maybe 10% because Damien talks about the EQRP boot camp and goes, a lot more in detail. Because, we make the argument, look, the one disadvantage of land investing over all the real estate niches is that there's no tax advantage because land never depreciates. It lasts forever. But if you use your EQRP, then you can get some tax advantages from land investing. And so a lot of people will bring up this concept of, the EQRP is great, but also look into infinite banking And for whatever reason, I mean, I've always kind of just shied away from it. But now, all right, Chris is back. So, Chris, we were arguing about the advantages and disadvantages of the EQRP versus this infinite banking concept and whole life insurance. But now that you're back, we're like, it always happens like at the best part, somebody has like an internet, problem. So let's go from where you're talking.
From where I was talking?
Yeah. About the whole life insurance.
Yeah, last I heard you were recapping it. So like you said, here's the thing with the death benefit is the death benefit is purely bonus. But what it does give us is that tax shelter, right? And not to mention some actual real protection too, liability protection. I mean, in most states, you could be a millionaire and people could not touch this money even if they win a lawsuit. Creditors, lawsuits, things like that, they can't touch this money. So, unlike, most of the savings that we have, right? I mean, other than like a 401k, almost anything is up for grabs when somebody sues you, right? If there's any kind of liability, but here the money is safe. On top of that, and really what makes this special is that leverage component. Like we talked about that compound interest of the savings versus the simple interest of the loan, right? Here's why that's so important is that you don't have to make the same interest rate to beat the interest rate. And so, for example, I mean, we talked about even just earning half the interest rate to then at least break even, right? To at least, match the interest that's charged on us. As Scott had mentioned, as the balance goes down on the loan, the interest goes down too, the amount of interest being charged. Vice versa, when as money compounds, it snowballs, it goes up. So there's this curve that goes upwards while the other curve goes down, right?
Right.
And so if you have something like whole life where, say, this is even a bad example. This is actually more conservative than what you get in reality. Say you're charged 5% for the loan, but you earn 4% compounding. Yeah, you're kicking butt. I just did an example for a real estate professional just the other day where it was roughly about $100,000 he would borrow out to buy like a duplex as well as a single family rental, right?
Right.
With that, I mean, that was his down payment. And so we actually I love to leverage the banks for their money. I leverage as much as I can, and then I use this for the rest. And so the cash down payment, when you can't leverage it, can't usually loan unless you're doing a hard money loan at like 8 or 9% plus, right?
Right.
We went ahead and said, hey, we'll do it from here. Now, when we did that, we took the cash flow and paid back towards the loan, which just frees up the cash to use again, just like a 401k loan. The difference is 401k loan, you might only get like 1 or 2 loans at once, right? 2 max, usually 1 loan you can have it at the same time, and you have to pay it off before you get another loan. This one, you can have dozens of loans out all at the same time. There's no limit to how many loans you can get. And so,
okay, well, what sucks about this concept? Because why isn't everyone doing this?
Well, what sucks is that you got to find somebody who actually is willing to cut back their commissions and the insurance costs. Because here's the thing, even with me right now, I've been retired for the last year or so. So like I've been kind of doing this more for fun the last year. And it's interesting because like when I find out all the kind of the ins and the outs, all the art behind it, right? My whole goal is how do I get you to get the minimal amount of cost to be able to stuff in the maximum amount of cash? And if you have at least a good 20 plus grand a year, depending on your age and health, of course, but if you have at least 20 grand a year you're putting toward investing, this is probably a great option. Because here's the hardest part, and this is the part that sucked for me. Because I've sold, like I said, I've done insurance for the last 16 years. I remember when I first got my first whole life policy, when I was starting to do real estate investing and things like that. And maybe you guys had the same experience, but my first policy, you didn't have any cash in that first year. It was pitched as being this long-term thing. So even the whole infinite banking, be your own banker concept was like, oh, that's 5, 10 plus years down the road. And then you can leverage the cash. Then you can go and finance a car rather than using the bank and stuff, which by the way, I still go to the bank to finance a car. I don't use this because I'm going to get a better rate with the bank. So I'm going to go with the cheapest interest rate and the best terms, right? So that's where I go. But I got sold a policy and I asked the guy point blank. I'd already been insurance licensed for 4 years. I knew insurance. And I asked him, I said, hey, can I stuff in more cash than what you're saying it's required? His answer to me was no. So I said, all right, well, I guess this is just the thing. It takes 17 years to break even, 17 years of premiums to have that much in cash value savings, right there available. All right, cool. It's kind of a longer term deal. Got it. Guess what? A couple years later, I learned that he flat out lied. I had a 2-hour screaming match with this guy. You know what I found, what it really came down to after we argued back and forth about what's the right way to do it? He finally just said, Chris, I couldn't do it that other way because it cuts my commissions. I was like, dude, I want a base. Like, that's just stupid. You know, because of commissions, that's really what it comes down to, is that. And see, he had a scarcity mentality. He thought, well, if I cut back all these commissions, then I don't make anything. It's not worth my time. But I found that because I cut back the fees so much, people stuff in more money anyways, because they're like, well, this is like a savings account. Yeah, it might cost me like maybe 20% of whatever I put in that first year. But by the third year, there's more going in. It's building more cash and interest than even a savings account will. Like, it's kicking butt. In fact, by the fourth or fifth year, you already have the same amount of cash in savings, in that savings, as you put in. So already you're pretty much at what would be like a savings account anyways. But the cool thing is you can use it from day one. Once you get that cash in there, you can go and use it to go and invest with. So I have people that right now, they just got it set up a couple weeks ago, and they're borrowing cash to go do their investments with their real estate and stuff. So they don't have to wait 17 years or whatever. Like, you can use it right away. Or you put the cash in, say you put in 40 grand, that means you'll probably have about at least 32 grand available to use right away. That's not even talking about the compound tax-free interest you're earning and stuff, right?
Right. Okay. So Scott and I both have an EQRP, a qualified retirement plan. We can each put in like $53,500 a year in this plan. Right now, it's got a tax-deferred or tax-free vehicle. Right. Well, let's just say we're using the tax-free vehicle of it, and during this time, let's say the next 90 days, Scott and I don't have anywhere to invest. We're looking for our next big real estate land deal or whatever it might be.
Yeah.
Right. Could we put some of that money into a whole policy of life insurance and do the supercharged savings account and then borrow from that and leverage it to do our deals and really kind of amp up our returns?
You could cash money out of those, yeah. Now, here's the thing. Depending on which kind it is, if it's more like the Roth, right, where it's already been taxed, obviously you can access that cash and it can go in. Because this has very similar tax rules as a Roth IRA. The only difference is you can stuff in a lot more money. So where you guys are putting in the max $53,000, I actually have people are putting in $500,000 a year as their max that they could put in. You know, so I mean, as long as you can qualify for the insurability aspect, you know, we try to stuff in as much cash as possible. And so I have a lot of people are putting in over 100 grand, and the same thing. But here's the cool thing is that there's no 10% penalty on trying to pull out the growth or anything before you're 59.5. There is no 59.5 rule. So this money is accessible to you all you want.
So, so using this use case, 90 days goes by, we're making 4% in our infinite banking or our supercharged banking account, and all of a sudden we see this huge land deal that we want to buy. We pull that money out penalty free and then invest it. So it's a 1-2 punch. It's not either or. It's
how do you get both?
You
how do you have your cake and eat it too? Yeah, it's earning interest and using it. So it's not just, and that's the hardest part for people to grasp. They're like, wait a minute, well, if I put money in this, this life insurance type thing, well, now I'm not making money on my investments. No, you're doing both. You're just, instead of putting it into your savings account to then cash out, we're putting it in, letting the insurance company give you a secured line of credit against your money to then you can go and leverage the crap out of that while your money's still building and growing and compounding tax-free the whole time. And so, now this didn't always work with the numbers before, but when I realized how much I could cut costs back, because like I said, like most people in the first year or two have zero cash. In the first 2 years, usually people will have almost 90% of their cash back that they've already put in. So that's like the cost. That's the downfall, I would say, is you got an upfront cost. But after that, the costs start going down. And like I said, like pretty soon you're making, like even after the 5th year, you're probably making at least a % average return on that, plus your investment returns already. And then after that, it's like 4 or 5% tax-free. It's awesome.
Scott Todd, what are you thinking?
I mean, look, I think Chris has a good idea. I mean, one thing is you got to be able to qualify for it, right? So, health wise, you gotta be healthy, like you can't.
That's why I'm on the treadmill desk, baby.
All right. So, you gotta be able to qualify for it. And then like Chris, realistically, how long does it take me to get this thing set up? Cause I got to have the insurance agent come out and, approve my health and do all that stuff. Like 4 weeks, 6 weeks?
It depends. I mean, this time, if it's Christmas time of year, it kind of sucks, but it takes a little bit longer. But most of the time, yeah, usually within a month or two, you can have it totally approved. Just depends. I mean, like, for example, an agent doesn't have to go see you. I mean, you can do this stuff all over the phone or online, like I've done with most everybody around the country. But, you send out a paramed to your house, so they do what I call a poke and pee test. So they take your blood and your urine sample, right? And then after that, usually it's within a month. They can usually get approval to say, all right, you're approved, and here it is. And here's a cool thing too. Like I talk about the max you can put in. You don't have to put in that max every single year. So unlike some people they're committed to put in a certain premium every single year, it's flexible. We could put in more, we could put in less. We could change the plan. We can even make it paid up so that you don't have to pay any more premiums at a certain age, whatever age we decide to make it at, and you're done. You're like, cool. And it just keeps growing and compounding without you putting any money in at all. So it's pretty awesome when you realize like how you can use it. The hardest part is that you can use it in so many different ways that your imagination really becomes the limitation,
So for people, let's assume you're healthy and you're young, right? Or relatively young. Who is this not for? Who would you say probably not a good idea?
Yeah, like somebody who's like cash strapped, like you just don't have any extra cash flow. I mean, the best thing I would suggest right now is get a cheap term policy that can convert to one of these policies later on without you having to requalify. In fact, I had a client in Maine. He was 60 years old, perfect health. He was a chiropractor up there. And he actually had got his whole life policy and he got a term policy. And just 2 years after we got the policy set up, he got a brain tumor. Now, he flew all over the country, got chemo, he got naturopathic treatments. He got it all done, pretty much cured within a year and a half. It was gone. No evidence of it at all. But he will never be able to get insurance again. The cool thing is he got approved at the top preferred rating. So with his term insurance, so he can convert that to whole life at any time. And they can't take that rating away. He still gets the best rating as if he never had a brain tumor. So for that reason, that's a big reason right there.
Yeah, but when I read the conventional financial literacy books, they always say buy term, invest the difference. Your financial advisors typically thinks it's a horrible thing to do are these expensive whole policies. So you're sort of twisting it and saying, well, not necessarily. And so make that final argument.
Yeah. You got to understand where education comes from. This is a little bit of like a rich dad, poor dad moment for you, because you got to understand that everything that financial advisors teach you, they do not come from them being awesome investors. Would you agree with that?
I agree.
Yeah. I mean, like they're idiots really when it comes to actually creating money, creating wealth. Here's what it is. Think about insurance agents. That's who's the one that says, hey, buy term, invest the difference usually, right? Well, why would they teach that? Why would an insurance company tell them to tell you to buy term, invest the difference? Here's exactly why. Term insurance, if you ask almost any insurance company, and I've talked to several company presidents about this, when they talk about their numbers, term insurance only pays out between 0.5% to 1% of the time. So think about it. If you're a business, you own an insurance company, and you're thinking, how can I make more money? You know what? Almost nobody dies with these term insurance policies. And I bet you know what I should do? I should tell people to cancel their policies right before they die. That would be the most profitable, awesome thing I could do, because then I don't have to pay out anything. I just made a ton of premiums for the last 10, 20, 30 years. And voila, I'm rich. So think about it. Term insurance is cheap. It's easy to sell. And then two, most never pay out anyways. So of course, if you're an insurance company, you're going to tell your insurance agents to teach that very crap about buy term, invest the difference. But if you're an investor, if you're somebody who thinks like a wealthy person does, you're thinking, hey, my estate attorney knows I'm going to have a big tax issue anyways at death. He's going to tell me if I'm 60 or 70 by that point, say, you know what? You should probably buy a whole life policy now that you're old and expensive. Here, go buy this now, right? No, buy it while you're young and it's cheap, as young as you can, and that's the thing is like all that crap is taught by insurance companies. They're telling you to do the very thing that's profitable for them. Whole life pays out because it's your whole life. It pays out regardless. That's the cool thing. So yeah, and I know the whole buy term invest the difference, but they're not thinking from the perspective of how do I double dip my investment returns? How do I make money here and there? How do I make it in my investments and inside the savings account? That's the thing that they're not teaching you. And that's the difference of what I'm teaching right now. And I'll tell you, like, I've never seen anybody who cuts costs as much as I do that's able to maneuver it and make it work like I have. I've only seen a few people do it, and they've just tied me. They've never beat what I've done.
All right. So if we want to learn more, how do we learn more?
You know, a great thing you could do is, one, you can check out my show, The Chris Miles Money Show. It's a podcast. Obviously, you can go check out on iTunes or wherever, I actually teach some of those principles on that. You can also, reach out to me through my website on moneyripples.com.
Okay. And if I personally want to just go ahead and get started, how do I do that?
Just reach out to me. Just message me. You can message me through my site or chris@moneyripples.com to send me a direct email. That kind of thing.
Okay. Amazing. Amazing. All right. Well, as is our show format, I know, Chris, you've already done this before, but I do have to ask you for another tip of the week, a website, a resource, a book, something else actionable where the Art of Passive Income listeners can go improve their businesses, improve their lives. The mentorship has been amazing, but I'm going to extract one more tip from your sagacious brain.
All right. I know you couldn't see that. I just pointed to my brain there. I'm accessing it right now. So, I would say this is that, again, everything's about leverage. And I know you guys teach this so much, but leverage is like the ultimate key, especially when you create it towards cash flow. You don't have to save up millions of dollars. If you can create leverage and you can try to get your money working harder for you, it's amazing how little money you can use to create massive results. And I know you guys are products of this, so I'm preaching to the choir, but I just can't reemphasize that enough, because I see people in their lives, the hardest thing, they make it too hard in their mind. They think that it has to be hard. And so they automatically reject what could be profitable or easy or what could actually be amazing, and they reject it. So that's the key for this week.
All right. Scott Todd, what's your tip of the week?
Mark, check out this app. It's called TryTailor.com. That's TAILOR, Taylor. TryTailor.com. And what you do is, how you'll do a screenshot on your phone, like screenshot, and then you got to scroll up and do another screenshot, like if you're trying to do like multiple things, like multiple segments or something, like maybe maps and directions or a website, and you just want to send the whole thing.
Right.
What this app does is it takes those screenshots and it connects them together. So it's just one long picture, if you will, as opposed to 10, 15 different pieces.
Huh. That is very useful.
Yeah, it's very useful.
Wow.
Yep.
All right, I'm getting it now.
I'm good, man. I'm good. This is how I spend my time. You spend your time finding investments. I spend my time finding apps.
I used your alarm app last time, and man, that drove my wife nuts when all of a sudden it's 3, 2, 1. She's like, "What is that? Turn it off. It's waking me up."
Yeah. That's the idea. It's supposed to wake you up.
That's right.
Yeah. Wow, this is great. And it's free.
It's free, man. It's free.
Wow. All right. Done and done. Try Taylor. All right. Well, my tip of the week is learn more about supercharging your savings account. Go to moneyripples.com. Moneyripples.com. Chris Miles, are we good?
We're great.
Do you think, did we cover enough? Should we have you back again?
I hope not. Man, it's weird. My computer wanted to update right in the middle of the show. I was like, of course it would, right? That's what happens when I get a PC.
Yeah, see, there you go. All right. Well, I want to thank you again. I want to remind all the listeners the only way we're going to get the quality guests like a Chris Miles from moneyripples.com. You got to do 3 little favors. You got to subscribe. You got to rate. You got to review the podcast. Send a screenshot of your review to support@thelandgeek.com. We're going to send you for free our $97 passive income launch kit. Pretty good. Today's podcast is sponsored by geekpay.io. Go to thelandgeek.com/geekpay and get set up and get your first note for free and just automate getting paid. It's amazing. Geekpay.io. Scott Todd, are we good?
We're good, Mark.
All right, man. We're going to have to argue about this and figure out some creative way to get going here with Chris.
Sounds good.
Sounds good. All right. Well, I want to thank everybody, and let
freedom
ring. Thanks, everybody.